Requirement Part B. Review the financial manager of UberTrack Limited's deferred taxation journal entries for the financial year ended 31 December 2018. Provide feedback to her in a memo. Therefore, immediately, guys, you know that you need to include a memo format that details your concerns with regard to any inaccuracies that are apparent from the information provided. Support your feedback with reasons and brief calculations together with a suggested correct treatment of any inaccuracies noted. Your discussion should not include any journal entries. Guys, you need to discuss. Now, when we look at this word inaccuracies, what does this mean actually? Number one, you need to identify and look at the journal entries, the debits, the credits. Is this correct? Number two, identify profit and loss or OCI, statement of financial position, and so forth, allocations. Number three, identify the amounts. Correct. Number four, the rates. Is this correct? And number five, any other issues that you identify. Now, when you look at the requirement, they indicate to us, support your feedback with reasons and brief calculations, together with suggested correct treatment of any inaccuracies noted. Therefore, one, you need to identify the issue, the error. Once you have done this, two, you need to identify if and how this can be corrected. But you should not include any journal entries. Right, now the indicator as discuss each journal separately, communication skills, 1 mark. Assume that all amounts are material. Round off all amounts to the nearest rand, and your answer must comply with IFRS. First step, new page. Indicate that this is part B, and we need to include our format. Most probably this will be your communication skills marks. Therefore, indicate to the financial manager from the student the date, the subject. Dear Madam, please find below the concerns and suggested corrections of the inaccuracies noted in your deferred tax journals and calculations. Now guys, you can also include, refer to Appendix A, and then on a new page include Appendix A. Should you have any further queries, please contact me. Regards, student. Right, you will identify on the left side the given scenario, and I will include our discussion on the right side of our screen. Remember, we have identified in terms of inaccuracies, we need to look at our debits, credits. We need to look at possible profit loss, OCI, statement of financial position issues. We need to identify if our amounts are correct. 4, we need to identify rates. And 5, any other issues. Okay, so level 1 students, please bear with me. You will be able to answer this question. Now, we need to look at this journal by journal. Now, the first journal entry, remember, they've indicated to us this relates to land purchased for 1 million on 1 March 2018. The land is held for long-term capital appreciation, and they've indicated to us that this is investment property at fair value model. The fair value of the land amounted to 1.1 million on 31 December 2018. Okay, so guys, remember, you do not have to include your deferred tax calculation. Now, let me just write this down. You do not have to include your deferred tax calculation. I do this to explain to you the discussion. Now, if it helps you to include the deferred tax calculation, please do not waste too much time on this because you need to discuss. But you need to ensure that you understand what you're discussing here. Okay, so when we look at this, remember, this will be our land, which is investment property. They indicate to us at fair value. Now, in terms of our deferred tax, the carrying amount for our investment property, remember, will be the fair value. Therefore, this will be our 1.1 million provided to us. Our tax base of an asset will be amounts deductible in future against any future economic benefits received from that asset. Therefore, our tax base in terms of the cost portion will be 0, because they will only be able to deduct that portion in future once they sell this and realize a capital gain. Alright, when you look at the deferred tax calculation, remember you do not have to perform this. I do this to explain to you the scenario. Remember, we have our investment property, land. We have 1 million carrying amount cost value. Tax base of an asset will be the amounts deductible in future against any future economic benefits received. Therefore, in future, once they sell the investment property, remember, either for long-term capital appreciation or the date when they sell this property, they will be able to deduct the 1 million. Therefore, our tax base is 0 and our deferred tax is 0. You with me on this one, guys? Okay. Then, the carrying amount in terms of the fair value adjustment. Remember, this fair value adjustment will be recognized in our profit and loss. But in terms of IAS 12, and this will be paragraph 51. No, guys, I'm lying to you. Paragraph 47. In terms of paragraph 47, we need to apply our CGT rate, because we assume that the investment property will realize through sale. Therefore, if the investment property realized through sale, we need to apply our CGT rate. Okay, now, when we look at this, our journal entry will be then to what, guys? Debit what and credit what? The carrying amount of our asset exceeds tax base of our asset. Therefore, this will be a taxable temporary difference. If this is a taxable temporary difference, this will be a deferred tax liability. Therefore, we need to debit our income tax in our profit and loss and credit our deferred tax liability. Now, let's have a look at what they've done. In the journal entry provided to us, they have debited the deferred tax asset and credited the income tax expense. Now, we disagree with this. Therefore, in our discussion, in terms of the debit and credit entry of the journal, we need to indicate that we disagree. Therefore, we can indicate that this is wrong. Why do we state this? Because when we look at the above, guys, the temporary difference will be a taxable temporary difference. Why? Because the fair value increase is a taxable amount. When you think about your current tax calculations, the fair value adjustment increase will result in a taxable amount. Therefore, our taxable temporary difference will result in a deferred tax liability. Therefore, we will have to debit, now this you need to write out, debit the income tax in terms of the deferred tax in our profit or loss. And we need to credit the deferred tax in our statement of financial position. Right. Therefore, first issue identified. Next issue. Look at the journal entry, guys. They have credited OCI. Now, we will only credit OCI when we look at revaluations, mark-to-market reserves. This doesn't make sense because we have a fair value adjustment. A fair value adjustment is recognized in our profit or loss. Therefore, we now need to indicate in terms of the profit or loss and our OCI section that it is incorrect to recognize this through OCI. Therefore, incorrect to recognize this through OCI, this should be through profit or loss, because this is a fair value adjustment in terms of investment property recognized through profit or loss. Therefore, the tax will influence our profit and loss and not the OCI. Now next, guys, we have discussed the debits and the credits. We have discussed the profit or loss and OCI. We need to look at our rate. Now, when you look at the journal entry, they have only multiplied this by 80%. But we know, guys, that due to the fact that this is investment property, that the tax rate will be, the tax will realize, we need to include this, will realize through sale. Therefore, if this realized through sale, they need to use the CGT, capital gains tax rate, and not only the 80%. Remember, guys, identify the inaccuracy, then write down what they should have done. Inaccuracy here is the fact that they have only used the 80%, not the 28%. Okay. Then the last one, in terms of the amount. Oh, guys, my spelling, sorry. The amount. Therefore, the deferred tax liability, important, the deferred tax liability to be recognized will be the 100,000. Now, guys, if you have included your calculation, refer to the calculation. If not, you need to include this here. This will be the 100,000 times the 80% times your 28%. How did we get to the 100,000? It's the 1.1 million minus 1 million. Again, guys, I'm going to tell you this. If you have included calculations, rather refer to your calculation. For example, I will refer to my calculation as reference B. No, sorry, guys, reference A at the top. I'm going to highlight this, let's say yellow, 20,400. And I will include here at the bottom that this is my reference A, and this will be 22,400, my deferred tax liability. Journal entry number 2. Okay, so on the right side, you will identify, again, guys, I prefer to make use of the deferred tax calculation, but you do not have to do this. I do this as it actually makes more sense. Okay, so when we now look at this, remember, we have identified that this is a software bookings system, therefore IAS 38 intangible asset. And then they indicate as they've purchased this asset on 1 January 2017. Therefore, when you now look at our timeline, guys, on the right side of your screen, when you look at the timeline, initial recognition date is 1 January 2017. They indicate as the useful life on this date will be 6 years. Then, during 20.18 financial year, UberTrack's new information was available, and they have estimated the remaining useful life and residual value. They re-estimated this at 3 years and 30,000 during finalization of the 2018 financial year. Right, now when we look at this during finalization, so they have identified, when we look at our timeline, that we have a new remaining useful life of, let me just get this, 3 years, and we have residual value of 30,000. Therefore, in terms of IAS 8, do you agree with me that we need to take this into account in our current year, which is 20.18, as well as future periods? Therefore, we can conclude, well, not technically conclude, but when we look at the amount that they have used in terms of the carrying amount, this 206,667 is incorrect. Therefore, we need to indicate here that the carrying amount of the intangible asset is incorrect. Now, why do we say this? Because in terms of IAS 8, if there is a change in estimates, we need to apply this in the current year and future periods. Therefore, the carrying amount should be, now when you look at this, guys, I have used the original 310,000 minus the depreciation based on 6 years, which is 51,667. I need to take into account my residual value of 30,000. Divide this by 3 years, and my depreciation amount for 20.18 will be 76,111. Therefore, the carrying amount should be 182,222. In my deferred tax calculation, 182,222, positive and asset. Remember, the tax base of an asset will be the amount deductible in future for tax purposes. Now, when we look at the scenario, they've indicated to us that such indicated that they will not allow capital allowances on the software. Therefore, the amount that will be deductible in future will be zero, nothing. And this agrees to the journal entry recognized, guys, when you look at this. Okay, now, temporary difference. But before we look at the temporary difference, I want you to please refer to IAS 12, paragraph 15. And I want to look at this paragraph or work through this paragraph with you. Okay, so let's have a look. Taxable temporary differences. Now remember, when will a taxable temporary difference exist? When we have our carry amount of our asset that exceeds the tax base of the asset. And this will result in a taxable temporary difference, and we need to recognize a deferred tax liability. Remember, taxable temporary difference. Okay, so if we take this one step back, when we look at deferred tax, what is a deferred tax? A deferred tax relates to a timing difference in terms of our different rules for accounting versus tax. Therefore, deferred tax is a timing difference that will result in either a deferred tax asset to be claimed or a deferred tax liability, therefore taxable to be paid. Right, you with me? Okay, now before we look at paragraph 15, let's just take this a few steps back. Remember, when we need to calculate our income taxes, we need to start off with our current tax. And in our current tax calculation, we need to include our profit before tax. Remember, this is in terms of our accounting rules. We need to take out our accounting rules and we need to include our tax rules. And this, guys, will correspond with our temporary difference section in our deferred tax asset calculation. And we will calculate our taxable profit or loss, and based on this we will calculate our current tax. Right, now when we look at our deferred tax calculation, remember we need to include our carrying amount, tax base, temporary difference, and our deferred tax. Now guys, the temporary difference, this movement here, remember this movement will correspond with your current tax calculation. Right, okay, now when we look at paragraph 15, let's just quickly read through this. A deferred tax liability shall be recognized for all taxable temporary differences, right? Therefore, in our deferred tax calculation, if the carrying amount of our asset exceeds, let's say this is an asset and this exceeds the tax base, this will be a temporary difference, but this will be a taxable temporary difference. Therefore, we need to recognize a deferred tax liability, because this is what paragraph 15 indicates us. A deferred tax liability shall be recognized for all taxable temporary differences. Now, except to the extent that the deferred tax liability arises from, therefore, when you look at my calculation at the bottom, if this deferred tax liability arises from initial recognition of goodwill, or to B, initial recognition of an asset or liability in a transaction which is not a business combination, and important, at the time of the transaction affects neither accounting profit nor taxable profit. Okay. Guys, I'm honest, I think this is quite a challenging section of IAS 12. Right, when you look at the bottom, left bottom of your screen, I've included initial recognition. Now, if we take this back to a normal transaction, we will have to debit the asset, credit our bank, and this will be through our statement of financial position. Therefore, we can indicate that this will not have an effect on our accounting profit or loss, and this will not have an effect on our taxable income or loss, right? Now, we know for accounting there's depreciation, right? Therefore, we will have to debit depreciation, credit accumulated depreciation, and this will be through our profit or loss. But remember, when we look at paragraph 15, it indicates to us that where there is a taxable temporary difference, that taxable temporary difference can result in a deferred tax liability. Therefore, this taxable temporary difference, guys, think about this. This taxable temporary difference, in terms of this specific intangible asset, remember, technically speaking, in future, there will be no deductions. Therefore, tax base is zero. We have a carrying amount for accounting purposes. Now, this temporary difference recognized here, guys, will this be due to a timing difference where our tax and our accounting get together and this is zero? No. Guys, this is not a timing difference. This will be a permanent difference. The difference will remain there. Remember, our deferred tax relates to a timing difference. Therefore, when you think about your current tax calculation, in your current tax calculation, this will normally be what we have called in the old days, we normally call this our permanent difference. Because that difference, where we add back the depreciation, will always be there until the end of this asset. Therefore, that difference is not a temporary difference. Therefore, guys, look at the word. This difference is not a temporary difference, and purely a temporary difference, guys, can result in a deferred tax asset or liability. Therefore, it appears to be one in our calculation, but it's not. It's a permanent difference. It's not a temporary difference. Therefore, in terms of this permanent difference, we cannot recognize a timing difference deferred tax. Quite a mouthful, guys, and I'm honest, I do think that this is your challenging section in IAS 12, paragraph 15. Right, guys, please write this down. I think that this is something that tend to confuse you, and I do agree why, because when you look at prior years, how this were interpreted, I think there's quite a change, right? Okay, so I have concluded on the summary based on a few questions that I have worked through. Now, when we look at land, let's say just the cost portion is 1 million. Remember, tax base of our asset, sorry, I do keep on repeating this, will be the amount deductible in future for tax purposes. Now, in a scenario, you need to read option number 1. They can indicate to us that such does not allow a deduction. If such does not allow a deduction, we know that the tax base will be 0. Therefore, in our scenario at the top, let's indicate 0, and then there will be this temporary difference. But due to our discussion just now in terms of this temporary difference, guys, this will be exempt in terms of IAS 12, paragraph 15b, and this is technically due to that section, right? Therefore, there will not be any deferred tax. Now, let's have a look at the second option. Again, guys, we have our land at cost at 1 million, right? Second option, the scenario does not state anything in terms of the tax deduction. And this is the one that we normally get, guys, where the scenario doesn't state anything. Therefore, the tax base of our asset will be the amount deductible in future, and this will be the cost. Therefore, we assume that once we sell this asset, we will be able to deduct this cost, and our tax base will be the 1 million. Therefore, our temporary difference will be 0 and 0 deferred tax. Right, guys, therefore, my assumption, please read carefully. If you're not sure, please go for option number 2. Remember, option number 2, this is the scenario in one of our previous SICA questions, if you refer to SICA's website. But please don't spend too much time on this, guys. There's quite a lot of information, quite a lot of stuff to study. Don't spend days and days on this paragraph, please. If you do not get this right, most probably you will lose 1 mark. Let's say max 2 marks. It's not that much. Okay, now let me indicate to you why. You will receive a mark for your tax base, either 0 or 1 million, which can either be 1 mark or half a mark. For the temporary difference, guys, which will be in both scenarios 0, but you had to indicate exempt or 0. Therefore, let's say 1 mark or half a mark depending on the memo. And therefore, I state either 2 marks or 1 mark that you will lose. Right, to get back to journal entry number 2, we need to conclude that our temporary difference, guys, will be exempt, and therefore there will be no deferred tax liability. Right? Therefore, guys, the focus in this section is the amount that's incorrect, and then IS 12 paragraph 15, the fact that the taxable temporary difference is exempt.